Welcome to your ultimate pit stop, Piston Pundit, where we break down the latest financial and geopolitical shifts reshaping the world. For decades, U.S. Treasuries have been the backbone of global finance, a symbol of America's dominance. But now, that foundation is cracking. Countries like Japan, Saudi Arabia, and even the UK are selling off U.S. bonds at an alarming pace. Rising interest rates, geopolitical tensions, and shifting alliances are driving this wave of sell-offs. Washington is struggling to maintain confidence in the dollar, raising the question, is the dollar's global dominance nearing its end? Let's dive into the 7 key reasons why America's financial stronghold is at risk. Reason number 7. Japan's strategic shift, from bond buyer to seller. Japan has long been one of the biggest holders of U.S. Treasuries, quietly supporting America's financial stability for years. But now, Tokyo is dumping U.S. bonds at a pace not seen in decades. Historically, Japan bought U.S. bonds to stabilize the yen and protect its economy from external shocks. But that strategy is shifting fast. The Bank of Japan, BOJ, raised interest rates in March 2024 for the first time in 17 years, ending its negative rate policy. As of early 2025, the BOJ has maintained a cautious stance on further hikes due to concerns about economic growth. Higher yields at home mean Japan has less incentive to keep buying U.S. debt. Japan's growing defense spending and economic revitalization plans under Prime Minister Shigeru Ishiba also mean Tokyo needs more liquidity at home. But the political layer here is just as important. Japan's growing discomfort with U.S. foreign policy in the Asia-Pacific, especially Washington's aggressive stance toward China, has strained diplomatic ties. Selling off U.S. bonds isn't just an economic move, it's a strategic hedge against rising regional tensions. But Japan isn't the only country realigning its financial strategy. Saudi Arabia is making a bold move toward China. Reason number 6. Saudi Arabia's shift toward China and the Yuan. Saudi Arabia's relationship with the U.S. has always revolved around oil and the petrodollar system. For decades, Riyadh priced oil exclusively in dollars, reinforcing the greenback's role as the world's reserve currency. But that foundation is starting to crack. In 2023, Saudi Arabia signed a series of major trade and energy deals with China. Reports have emerged that Riyadh is considering accepting Yuan for oil sales, a direct threat to the petrodollar system. Why the shift? Political tensions are part of the equation. The Trump administration's criticism of Saudi Arabia's human rights record and disputes over OPEC plus production cuts have strained the alliance. Meanwhile, China offers a more stable trade partnership without political baggage. If Saudi Arabia moves to a yuan-based oil pricing system, it could reshape global energy markets and weaken the dollar's dominance as the world's trading currency. The petrodollar system has long been a pillar of U.S. financial strength. If it falls, the dollar could lose its global edge. But it's not just Saudi Arabia. Other nations are looking for alternative financial safety nets beyond the dollar. Reason number 5. The rise of alternative reserves, gold, yuan, and crypto. For decades, the U.S. dollar's dominance as the global reserve currency was unquestioned. But that's no longer the case. Central banks around the world are stockpiling gold at record levels. According to the latest IMF data, as of January 2025, global gold reserves have reached an all-time high. In 2023, the People's Bank of China added over 100 tons of gold to its reserves, signaling that Beijing is preparing for a future where the dollar isn't king. Russia and India have also boosted their gold reserves, reinforcing this shift. At the same time, cryptocurrencies and digital currencies are becoming more mainstream. Countries like El Salvador have adopted Bitcoin as legal tender, while others are experimenting with central bank digital currencies, CBDCs. The rise of crypto and alternative currencies reflects a growing desire to escape the political and financial risks tied to the US dollar. If this trend continues, the dollar's dominance as the world's reserve currency could erode steadily, reshaping the global financial order in the process. And this erosion is being accelerated by the very institution meant to stabilize the U.S. economy, the Federal Reserve. Before we delve deeper, do us a favor and smash that like and subscribe button. This helps us reach more auto enthusiasts just like you. Now, let's shift gears and steer towards our next point. Reason number 4. The Federal Reserve's gamble, high rates and higher risks. The U.S. Federal Reserve's aggressive interest rate hikes have created a dangerous paradox. On one hand, higher rates have attracted capital into U.S. bonds by offering better returns. On the other hand, they've triggered a massive sell-off of existing bonds. When interest rates rise, bond prices fall. That's basic market mechanics. But the scale of recent rate hikes has intensified this effect. Countries holding billions in U.S. bonds are now facing a tough choice: hold on to depreciating assets or sell and reinvest elsewhere. More concerning is the rising cost of servicing America's $35 trillion national debt as of January 2025. Higher interest rates mean higher debt payments, and that's putting pressure on the U.S. budget. If foreign bondholders keep selling, America could face a fiscal crisis where rising debt payments crowd out other government spending, leading to political and economic instability. Even America's closest allies are taking steps to reduce their exposure to U.S. debt. Just look at the UK's strategy post-Brexit. Reason number 3. The UK's post-Brexit financial realignment. The United Kingdom has always been one of America's closest financial and political allies. But even London is rethinking its financial strategy. Since Brexit, the UK has been trying to strengthen its financial independence and diversify its reserves. A key part of that strategy? Reducing reliance on US bonds. London has been shifting focus toward trade with the European Union and Asia, especially China. Brexit forced the UK to reassess its economic future. Strengthening domestic financial markets and cutting exposure to US bonds is a way to reinforce that independence. British policymakers have framed this as strategic diversification rather than a lack of faith in the US economy. But the timing says otherwise. Political instability in Washington is only adding fuel to the fire. Reason number 2. Political instability in Washington, a growing liability. America's political dysfunction is no longer just an internal problem. It's now a global concern. The repeated battles over the debt ceiling, constant government shutdown threats, and partisan gridlock have shaken confidence in Washington's financial leadership. When Fitch downgraded the U.S. credit rating in 2023, it sent a stark message. Political instability in America is creating real financial risk. For decades, U.S. bonds were considered the safest investment in the world. Now, countries that once saw U.S. bonds as a stable asset are second-guessing that assumption. Political dysfunction has always been a factor, but the sheer scale of division and gridlock in Washington is pushing some allies to explore alternatives. But the biggest challenge to the dollar is coming from two major geopolitical players, China and Russia. Reason number 1. China and Russia's challenge to dollar dominance. China and Russia aren't just competitors. They're actively working to undermine the dollar's global dominance. China has been building a Yuan-based oil market and expanding trade agreements that bypass the dollar. The Belt and Road Initiative, BRI, is at the center of this strategy, creating trade routes and financial ties that cut out the greenback entirely. Russia has followed a similar playbook. Its sale of oil and gas in non-dollar currencies, especially to China and India, has strengthened the ruble and reinforced economic ties with major global markets. The expansion of BRICS, Brazil, Russia, India, China, and South Africa, further strengthens this push toward a multi-currency financial order. The verdict: the end of dollar dominance? The coordinated sell-off of U.S. bonds by 16 allied nations isn't just a financial adjustment. It's a symptom of a larger geopolitical shift. The dollar's dominance isn't disappearing overnight, but the foundation is cracking. If countries continue to diversify their reserves and reduce reliance on the dollar, America's ability to influence global financial markets will diminish. So, what happens next? Can America adapt and reclaim its financial leadership? Or are we witnessing the beginning of a permanent decline for the dollar? Let us know what you think in the comments. Don't forget to hit that like button and subscribe to Piston Pundit for more updates on the shifting global financial landscape. The world's financial order is changing fast. Stay ahead of the curve with us. Thanks for watching and see you next time.